Hello and welcome to Equiteq's Buyer Report 2022 webinar. Thank you for joining us all today. I am David Jorgensen, the CEO of Equiteq. I will moderate the discussion today with a few of my colleagues from our global geographies, each of whom will introduce themselves in a moment. As we give people another minute or two to join, here are a few housekeeping points. As you join the webinar, your cameras and mics are turned off. They will remain off throughout the webinar. If you have a question for the panel, please use the Q&A button on the menu below, and we'll get to as many questions as possible at the end of the discussion. In the case that you can't stay with us for the whole discussion, the webinar will be recorded and shared after the session. So let's start with why we're here today. So Equiteq helps owners and partners of knowledge economy firms to grow, acquire, and realize equity value. For almost 20 years, we've been publishing proprietary research on the M&A and market trends and acquisition and valuation drivers in the knowledge economy. In this past year, the sector has been the eye of a perfect storm, driving a boom in M&A deals and investments. And for the 7th consecutive year, we've asked senior decision makers from approximately 100 buyers and investors globally about how they see the outlook going into the next year and beyond. And this webinar is intended to share our insights and findings with you. This will take the form of a 25-minute discussion between our panelists, followed by 15 minutes answering your questions. As a reminder, please feel free to post your questions using the Zoom Q&A button. So let's get started with introductions from our panel. Paul?
Thanks, David. Paul Dondos, I head up Equiteq's market intelligence practice globally, as well as producing this buyers research report. We also produce other reports on trends in the economy, backward-looking on transactions that take place, specific subsectors. Very pleased to be here today to talk about this report and its implications for the knowledge economy.
Jerome, go ahead, please.
Sure, David. I'm Jerome Glyn-Smith, MD for Equiteq in European consulting and digital services sectors. I essentially help entrepreneurs and private equity realize liquidity and realize transactions, as well as actually achieve build up and acquisitions.
Thank you. And over to Sylvain in Singapore.
Hi, everybody. I'm Sylvain Mason. I'm a director at Equiteq. I'm based in Singapore, and I'm in charge of deals across the entire APAC region.
Great. So let's jump right into the questions. I wanted to start off right in the deep end. The survey that we've just published showed 70% of the buyers that we spoke to believe that sector M&A market is overheated in the knowledge economy, but less than 20% have reduced their participation. So that seems to be a bit of a conflict. Why would that be? And that's a question for the whole panel. So maybe we go in the same order. Paul, your thoughts on that to start.
Well, I don't think it's a non sequitur. I think the fact that it's overheated comes from the fact there are fundamentals that are driving appetite to acquire in this particular area of the economy. The question is about whether participants have the means to take a role in this or not, but that's not going to stop them wanting to participate. So clearly, there's actually a link between those two things, and I think that has some way to run, as I'm sure we'll come on to.
Sure, Jerome. Any other thoughts there?
Sure. I think when we think about the M&A markets and why people are looking to invest, why people are looking to acquire, I think there are a number of themes we'll come back in the rest of this webinar. But I think it's a question of time to market for a lot of trade strategics. How quickly can we fulfill this demand? How quickly can we innovate in this context of hyper competition, hyper resource scarcity? How do we do that? And I think M&A has come across to be one of the key sort of tools to achieve that. And that, in conjunction with a lot of liquidity in the market, has created a favorable sort of environment for what we're looking at today.
Got it. And Sylvain, what about the view from your perspective? Anything different that we should hear about the Asian market?
I fully agree with my colleague and what they have described. It's a global trend, generalized across APAC, but the entire block.
Yeah. Okay. Interesting. So to be a bit more specific, and I'll put this question to Jerome. The survey showed that even though buyers and investors are continuing to participate, they're changing how they are engaging with the market. What does that mean, and what are the kinds of things that we're seeing, Jerome? If you could answer that one.
Sure. No, I'm happy to take that one, David. So I think we when you're a buyer in this market, you're dealing with hyper competition. You're dealing with very high valuations, which is a theme we'll touch upon later. And I think there are certain things that and behaviours that we're seeing from buyers in this particular market. Thinking through this, I mean, I think one is definitely about building relationship with sellers and targets well ahead of time. So buyers have deliberate strategies today of understanding what a seller actually wants from his deal, and it'll often be a set of things that will go far above sort of terms and valuations. It'll be about culture. It'll be about the project. It'll be about potentially a solution for a diverse shareholding group. And what is that? And how can the buyer provide an actual solution and be differentiated over and above the term? So I think that's the first thing that buyers are doing more than they used to. The second thing that we're seeing is some of our projects we're not really able to take them to auction because we're seeing 3 or 4 buyers from the get-go come in and say, this is what we want to do, this is why we want to do it, and this is the price, at very, very high levels of price, and we want to execute very quickly, and being quite straightforward. And I think buyers are doing that more than they used to try and circumvent the auction process that carries a fair amount of risk for them. And then the third thing that we're seeing that quite a lot of people in the auctions that are auctions, and quite a lot of buyers putting in quite a few offers. So there's a bit of a volume game going on. So I think when you're a buyer in this market, it's a combination of building relationships, being extremely aggressive on certain key assets that you want to win, and then being quite opportunistic and volume based on the rest.
Yeah, got it. And speaking of the volume game, which really resonates particularly in the form of the private equity buyers, it was clear from the survey that while some of the participants said that the market heat might not last long, a majority said it was going to last 2 to 3 years, and they've also got more capital to do deals next year. And that would be particularly the case in the form of private equity. So Sylvain, wanted to put this question to you. Why are we seeing that type of behavior or that type of feeling out of the private equity space, and what do you think is driving that?
Yeah, I think this is driven by two main factors. In fact, first, the change of behavior of strategic buyers. We tend to focus more on the most strategic opportunities, where they have the highest chance to win, as just explained by Jerome, which resulted in an overall drop in participation of 15% by strategic investor last year, leaving the door wide open for private equities, which have seen their participation, in fact, increase by 22% this year and is expected to continue increasing next year. And the second key aspect is the amount of cash and funding available in the market and accumulated by PEs. Indeed, overall, as we speak, around 66% of the PEs we interviewed believe that more funds will be available on the market next year. Such availability of funds has pushed PEs to broaden their investment scope with an increased interest across the knowledge economy, and particularly in the digital services and management consulting space, which used to be mostly invested by strategic buyers. In terms of transaction size, also, while preferred size remain similar, they are now willing to look into smaller targets as part of bolt-on build-up strategies, with the ambition to create regional and global leaders. As a result, around 90% of the PEs interviewed believe they will complete more deals next year, and such sentiment is also, I have to say, shared by more strategic buyer who also expect to do more acquisitions next year.
Yeah, that's a good point and true. Although in this report was the first time that we've seen a slight moderation in the rate of increase that was predicted by the strategic buyers. And so there was one statistic in the report that the percentage of strategic buyers expecting activity to increase ticked down a bit. Could be noise in the data, but Paul, I'll ask you this question: do you think there's substance to that? As a particular signal that maybe the growth in the market is attenuating, or how do you take that?
Sure. I think there are reasons that you can throw at why things could be tailing off. You could think about the changes to the price of capital. You could think about the fact that there's a cycle in which the uptake of targets could somehow come to a point where the value of what's available starts to increase. But I really think that it's quite a small change, and I think it's probably got more to do with acquirers, investors almost holding on, if you like, in a time of great speed that the market is moving forward. There are cases that I've come across recently where very active acquirers are digesting some of the assets that they've acquired recently, and I think that that can translate into a certain reluctance to believe that this pace of activity can go on. But I think that's short-lived, and I think what is longer-lived are those underlying factors that make these assets attractive in the first place. So I think it's a wobble on the part of some of these acquirers and investors, which is a natural consequence of just how attractive the sector is proving at the moment, just how much competition there is for assets.
Yeah, it's absolutely true, and you can point right to digital advisory as an example of one of those sectors where the heat is only increasing. So over 70% of our respondents want to acquire digital advisory capabilities. So that's an area that is seen as driving continued growth. So Jerome, I'll hand this one off to you. Is there a limit to the digital side of this and the tech convergence, or how should market participants be putting that into context?
Yeah. I mean, it's a really interesting question that I think we get confronted with all the time with our vendor clients. Is it the right time, and how long will this last? And we'd like to say no limit. I think we'd like to think there's no limit to this. I think probably on a more serious note, it won't escape the fundamental cyclicality of investments. But I think what we're certainly dealing with a medium-term megatrend. We're not dealing with a short-term megatrend here. We're dealing with a medium-term megatrend with that cyclicality that will likely mean that over time, certain segments and subsegments of, for example, of digital that have been very attractive come into maturity, meaning that the investment and appetite around those segments it decreases a bit and is actually then backfilled by other areas of innovation within those segments, and that will sort of fuel an overall trend.
Yeah, and just diving in on that point, the types of technology, there's a broader, very strong interest in analytics and data technologies, but that's a, like you say, a medium-term trend wrapped up in the longer-term trend of how large companies consume expertise. But there's a real spike in interest across a real variety of specific areas, AI, RPA, cyber, blockchain, and particularly so from private equity. Paul, I'll ask this of you. Why are we seeing this take off where specific specific, very vertical, very sort of highly expert functions are taking off in this way?
I agree that this is something that's been around for a time, and it's spiked now. I think that is a case of maturity in understanding of the impact that data analytics have within more general propositions. I think you can look philosophically and think about optimization of data as being something that's more intrinsically involved in everything we do. And this translates in professional terms into propositions from consultancies, from knowledge experts in wanting to gain objectivity by applying data to break apart divisions, to increase collaboration, to raise the territories over which their proposition is operating. For private equity, it's also fundamental to having visibility over future earnings, having propositions that allow investors to be able to see a longer term perspective on what previously are very much project-driven firms that have a cycle of sales and delivery that's much shorter. So it's natural that data should make its way into the system, if you like, of how knowledge-based firms work and are valued. And those investors that are more sensitive to the visibility of paying down debt that's used to make acquisitions are bound to be responding positively to technology being able to translate that into real results. And again, this is what's going on a kind of higher level with private equity participating in our sector overall, which is that private equity are finding a way through knowledge economy services businesses, SaaS businesses, to play those technologies that have taken off more spectacularly previously as technology, with the valuations that we associate with technology. But actually, there's a different risk-reward profile that private equity are actually able to play by working in a service-based economy that's attached to that. And data is fundamental to that sequence.
Yeah, that's very interesting. I think that hopefully, speaking to our audience a bit, you're getting the sense for how, even though something from a distance might look like a small segment of the market, once you dig into it, it really does become very specific and very disaggregated the deeper and the more you learn about it. And so I think part of what we try and do at Equiteq is provide clarity into all of those complexities. So let's change lanes now a bit and talk about geography. Once again, in 2022, North America is the market with the most buyer interest. But this, as Sylvain, as you said earlier, the boom has really been a global one and a very consistent trend across markets. Maybe more so than ever before, in the sense where trends in the market are global. Asia and Latin America are increasingly of interest to global buyers and investors. So Sylvain, why is that, and what are we specifically seeing?
I would say that this is a consequence of what happened over the last 2 years across the globe, with more and more people being forced to work remotely, international travel being restricted to its strict minimum. All this has pushed companies to reorganize internally and to consider remote working as a viable alternative solution to deliver services. So in this entire context, nearshoring is becoming increasingly attractive for a lot of companies, which are all on the lookout for lower cost and high quality skill sets, which might be very difficult to find in their home market, where we can see more and more competition for the same type of resources, driving the prices up, and also making them very, very difficult to recruit and impacting the growth of their business. Such geographies are also seen as a good alternative to create innovation hubs with powerful training centers, where you can ramp up resources in a specific area where resources are yet to be available in the market. We can take, for instance, Anaplan as an example. Anaplan is not new, but it's emerging, growing fast, still a a technology where you do not have a lot of available people with that type of skill set in this market. So what better ways than setting up a training, powerful innovation center in a country where you have more people available for a lower cost. Another driver would be the fact that these areas can be seen and are seen more and more by investors as a potential driver for future growth in the business and a way to diversify their exposure to specific markets while benefiting from the very fast digital adoption trend taking place in some of these emerging economies, especially in Asia Pacific, LATAM, but also to some extent in Eastern Europe. So all in all, the combination of all these points is pushing investors to seek flagship investment in geographies that may already been present, but might not have seen as that strategic prior to the entire COVID situation.
Yeah, very interesting. And a lot of very interesting things taking place in a lot of very different places around the world. So incredibly exciting. Thank you. So, and what about sectors, Paul? You know, after a brief mention of healthcare as the most important end client sector in these surveys, buyers and investors seem to be back to looking at financial services as the most desired end vertical. How should we think about that? And what are we hearing from the buyer community about where they really want to play? Paul, you're on mute.
Apologies. They are playing around the innovation frontier, and those verticals are, of course, all exposed. All verticals are now. There are bound to be moments on the trajectory of digital transformation, innovation-driven transformation across the economy, where one vertical or another is favoured. But I think when you see in financial services, clearly something that commerce runs through with exposure right through different areas of innovation, regulation, different ways of working, all of which make that a key area for development for any consulting-based, software-based business. So it's natural that it should almost default back to financial services, but that's not to neglect other areas that really are proving to be areas of concentration for buyer interest, investor interest, and energy is one of those. Sustainability, ESG, clearly another of those. These things result, these interests, when they combine, you see funds launching on a great scale to pursue strategies from investors to play these. You see strategics looking to transform their organizations to make not just what I would call not just transformational acquisitions, but dimensional acquisitions. I would say that things that could be of a scale, regardless of the size of the asset, but the scale of the effect on the synergies that are produced by combination runs right across the organization, or otherwise is at least a part of a sequence of transactions that will continue to transform an organization to serve behavioral change, changing global commerce, changing global regulation. So you can point to a number of these. I'm not surprised that things are defaults to financial services, but anything that is exposed in this way to commerce, to regulation, to behavioral change is bound to be in the sights of buyers and investors.
Yeah, I get it. I mean, it's certainly not to say that, as you mentioned, a company doesn't need to be in financial services to be interesting, but financial services is a good example of the kinds of things about an industry that drives expertise and drives the need for specific expertise and spend. So I get that. It's a good point. And as we've talked about this from the buyer's perspective. So let's switch a little bit to the perspective from the sellers. When we think about how buyers look at individual firms, Sylvain, I guess I'll just ask you kind of a greenfield question here. What is the profile of an ideal target, and is that changing? And how are we currently thinking about the way in which a company who's thinking about selling into this market, how they should look?
I have to say that that's not changed much over the last 7 years. So in this respect, buyers are pretty consistent. They are still looking for a combination of qualitative and quantitative factors. If we're talking about qualitative factors, they are still looking about the quality of the management team and what they want to do after a transaction, what's going to be their involvement, the quality of the client base. They do favor blue chip clients rather than SMEs usually. We'll talk also about the uniqueness of the proposition. You can see a lot of emerging players playing in very similar fields. So any things that will differentiate yourself from your competitors and enable your company to be more scalable is something that's very attractive. In this aspect, IP creation methodologies remains of high interest and very much valued by potential investors. In terms of quantitatively, people are still very much focused on revenue growth. I'd say it's more important than ever. Now the minimum that's kind of accepted will be in the 10 to 15% minimum to be attractive. They are also looking at strong profit margins. I'll say the EBITDA rate, even if it's important, it's equally less important than the revenue growth. Staff retentions, turnover, it's also quite important as a metric. As mentioned earlier, as we can see more and more difficulty to recruit and grow the team in the market, especially in the sexy and very much look after digital services sector.
Got it. Thank you. Good. Yeah, that's very interesting. That particularly that buyers are, even if they're paying a little bit more, they're interested in the same fundamentals. Really, very consistent. And Jerome, what about structures? When we think about the kinds of deals that are getting done, what are we seeing in terms of how deals are being put together, and for example, with earnouts and other structuring elements? What's the trend there?
Yeah, I think the answer to that, David, is quite nuanced, and it really depends on the type of buyer or investor that you have. So I'd say that in this market, you've probably got three types of buyers for and investors for sort of consulting and digital services, and that will be your trade acquirers, which are normally sort of large consulting, large global IT businesses. The second category, which is a category that's getting bigger and bigger year after year, in a much more sort of exponential way than other categories, which are mid-market consulting and digital services businesses that are themselves backed by private equity and doing build-ups, and having sort of M&A as at the core of their strategy. And then I think your third bucket is, we call it private equity or financial investment, that takes a number of different shapes and forms depending on the sort of remit for that. And I think going bucket by bucket, I think the first bucket of those sort of global multinational consulting and IT majors, we're seeing that structure at sort of between 20 and 40% of deferred, and normally linked to actually making the people side work, the people side of the deal work. So things related to staff retention, founder team retention, attrition rates, making sure that that trend that I mentioned at the very beginning of actually using M&A as a tool in a resource scarce market actually works out. So that's what we're seeing in that bucket, and the higher the valuations, I think, the more the deferred, because there's a link there that's quite strong. In the second bucket of those middle market companies, we're seeing the structures being a combination of cash up front, deferred, and roll over into the holding company in the form of stock to actually bring the people into sort of hybrid private equity and trade solution. And the structure there will be more sort of EBITDA focused. So what we see in contrast with the first bucket is that those businesses that are backed by private equity are fundamentally structured on cash flows and LBO. And that drives a focus in the structure that is more around growth and actually delivering cash flows over a period of time. So that would be the second bucket, with normally maybe a bit more cash up front than on the trade bucket, and then a combination of deferred cash and rollover in the earnout. For private equity, I think what we're seeing is a very strong interest now in this industry, essentially driven by growth trends and driven by the ability to structure deals with a large component of low risk equity, be it in the form of preferred stock, be it in the form of loan notes, that actually give private equity a lesser sort of risk profile on the asset whilst being able to benefit from the growth. So that's I think what we're seeing across the different buyer and investor types, David.
Yeah, that's interesting. And the obviously structure is tightly linked to valuation. We've had several questions come in from participants, the audience here, about multiples. I think it's important now to address that. I'll stay with you, Jerome. We've seen, certainly over the last few years, a significant and sort of tidal shift in multiple expectations in the market. It's an open question, and I think we won't be able to predict the specific flow of multiples in the future, but they've gone up. And so how are the buyers thinking about paying more now than they did a couple of years ago? How are they making sense of that? And how are, from a seller perspective, how should sellers in specific niche sectors be thinking about multiples now versus what might happen to multiples in the future?
Yeah. So I think if the question is, how will a buyer make sense of paying today's valuation for and which could be, I'd say, at the moment, 30 to 25, let's say 25 to 35% higher than what it was 12 or 18 months ago. Okay. And I think the answer, is that accretive? I think the answer to that is yes, for the moment. I think as long as the demand for certain niche services is as high as it is today, as long as these anticipated synergies through M&A are there in the way that they are there today, and that M&A is a tool to actually address demand in the market, then these valuations that are, as I said, sort of 25 to 35% higher than what we used to see will be accretive. We've also seen, if you look at the market valuations, some of the leading consulting companies and IT companies in the world are trading 30 to 40% higher today than they were pre-pandemic. And that's creating the ability for trade deals to be quite rich, because whatever sort of multiple, for some extremely well-valued acquirers, whatever multiple they're paying, it's always accretive on their stock and the way the stock exchange is actually viewing them. So I think the answer is yes, it is accretive, but it is very much connected to that medium-term trend of super demand we're seeing for these services and niche capabilities.
Which I think you could say, there was a question in the chat about the IT as a service market is a good example of a market with an element of valuation increase that's driven by, enthusiasm at the current moment. And there's a part that's driven by a long-term secular trend towards the way that, IT is consumed and expertise is delivered. So, I think what I'm hearing you say is there's a bit of both. And there's stuff here that's not regardless of what happens with the economic outlook, isn't reversing. This is a longer-term secular change in the way that the business is done. Am I off base there?
No, I think that's right. We're talking about a revolution around digitisation that had a sort of medium to long-term outlook that's been accelerated by the pandemic. Consumption of cloud, consumption of hosting, consumption of digital and SaaS software has been accelerated through the pandemic, and we're dealing with this at the moment. And that is the impulse to this sort of medium-term trend we're talking about.
Sure. And Paul, from your perspective, working closely with the larger corporates, the global multinationals on their buying programs, what are you hearing from them about specifically valuation multiples and the form that they want their targets to be in? You know, what if anything nuggets can you offer to the audience who may be operating their own business, thinking about entering this market from the perspective of the large corporates?
Sure. Well, the first thing is that, as Sylvain said, the fundamentals are still the same 7 years on, or however many years on, right? But there are things around units of proposition, management quality around go on and growth in sales and so on, so that don't change. And as Jerome said, there are elements of digitisation that are part of a revolution that is being reflected in the attitudes of strategics towards what they need to acquire and how much they need to acquire it. Those translate into price, into the kinds of transactions that business owners can contemplate now. So in terms of nuggets of those preferences, let's call them, of strategics, I would say that it continues to be a seller's market, even more augmented by the confidence that those strategics can have in obtaining value through acquisition, right? This revolution of digitization, these innovations are making it automation as well. You know, they make it more feasible to get value out of a transaction. And therefore, strategics have a broader sense of what is, of the art of the possible, right? So I would say, you know, get engaged with an expert view on what can be done, because you will be, I think if anything, the movement is towards the possible being even greater than before in terms of what investors will contemplate in terms of what their capital can do and what the risk profile could be of investing in knowledge and expertise. And in terms of the way that an integration can function positively for the two parties, for the combined entity, I think that there's more enthusiasm than ever about M&A as a whole. And that replaces increasingly what was a reluctance to drive an inorganic growth agenda forward. And I think that's the high level message, I think, from the strategics we're talking to around the world.
Great. Okay, very helpful. So I'm going to probably have time for a couple more questions here from the audience. So Sylvain, there's a question from the audience about Asia and specifically asking a question about Asian domiciled businesses that are looking to potentially enter the Western markets. What are they interested in, and what is different about the strategies from the Asian companies thinking about their own acquisition strategies?
Okay. So first I have to say that before going to the European market, when you're an Asian company, I would like to emphasize that you need to make sure in terms of governance, in terms of internal management, you have reached some international standard. This is very important because you will be competing in Europe and in the US with companies that are extremely well managed, have very strong processes in place, and will not necessarily be competing on price, but be competing on quality. And you need to position yourself at the same level as these companies that are coming from more mature markets. So that's something that I think is very, very important, because we see a lot of companies in the region that have this ambition to go and serve more mature markets, but there is a big difference between having sales offices and representative offices while delivering the services remotely and delivering the services on the ground in Europe or in the US, because you do not sell exactly the same way, you do not deliver the same way. You might have some culture gap that you need to address before going there. So it can be a good strategy, but first you need to find the right partners that understand your values, your way of working, and to have very strong internal processes before contemplating that type of move.
Yeah, got it. Interesting. So one final question. So I'll ask this of you, Jerome. There's a question from the audience about the most common motivation for sellers when they're thinking about seeking a buyer for their business. Has that moved at all in the last few years? What is driving entrepreneur, founder, owners to sell at this time?
I think what's driving the M&A market today is price. I think people the typical reasons to sell or get investment were linked to the growth path of the company, shareholding dynamics, linked to a sort of a point in time where the company needs a next phase for it, and that's always been there, and that's still in there today. But what's happening today is that we're having people decide that they want to take the opportunity that is there today. And I sort of refer to a discussion with one of our clients where I was emphasizing with that and saying that the multiples we're seeing today in the market, if we see the tampering off, then you'll need to grow a hell lot more over the next 2 years to actually compensate for that. And there's that balance that we're seeing. So I think the reasons to sell remain the same and are normally connected to the journey of a company and its owners. But today we're seeing this drive to take the opportunity. Is there an opportunity to actually do something earlier and get liquidity earlier? And that's clearly driving the market.
Got it. Very interesting. All right. Well, I think that's about all we have time for. Very much appreciate everybody joining. Appreciate and thank you to the panel for answering a series of rapid fire questions here this morning. We'll send a link to the video in case you'd like to share it with colleagues or see any particular part of it again. We are wishing you a very good holiday season and a successful end to the year and a fantastic start to 2022. So thanks for joining, and have a great day, afternoon, and evening.